Hello and welcome everybody. This is Phil Grove. Welcome to the Canis Major video blog, deal case study of the week. And this week we have a very special and unique project to review. It's a portfolio of single-family homes. You may or may not know that another way to do multifamily commercial investing is to bunch together groups of single-family homes into a single portfolio. And our speaker today, Sanjay Aggarwal, is going to be presenting this deal and explaining how these deals were found, funded, and all the numbers along the way. So Sanjay, are you there?
Yes, I am. Thank you, Phil.
Well, let me turn it over to you.
So, thank you very much. So this is a project we started earlier this year for, like Phil said, 20 single-family homes, and this one is very similar to the, even though these are single-family homes, these are treated like a commercial project similar to the apartment complexes. And the reason for that is the way we structure this and how we finance and operate this. We'll go into the detail of those and talk about that. So before we get into that, just a little bit background about myself. I'm a mechanical engineer with 16 years of experience with University of Chicago Business School. I started in real estate early as I was working for different companies, and been a realtor license holder in Texas since 2015, and been working with Phil and Shanoa since 2016. Which is where really all of this took off. Some of the key projects listed here that you can take a look, but one of the main one is the 20 single-family home portfolio. So, these are mainly the 20 single-family homes, mainly Class C, located in the East Dallas and Mesquite area of DFW Metroplex. All the houses were within the 5-mile radius. And we were able to negotiate a 70% minus the repair for the purchase price and a considerably below market rent as an opportunity to increase those rents that we'll see later in the presentation. So a little bit about how we found the deal and the due diligence to do. This deal came through my network and previous relationship. Of course, network and relationship are a huge part of that, where Canis Major and the Big Dog Network is a huge network where the deals continue to come through that, and continue to maintain and improve that network. Once we had the deal, you did the due diligence for the deal, looking a drive-by, the most important part, online research, and then, going into the actual inspections of each house, documents review, rent roll, lease, insurance, utilities, tax rate, and of course, key part of the due diligence in these commercial deals is initial conversations with the lenders to make sure they can finance these deals. There are no restrictions because of areas or price of the homes or condition or any other criteria. So very important part of the due diligence. Once you have the deal, the negotiation part, one of the important negotiation that I start with is giving the seller confidence that we are a strong buyer and demonstrate our financial strength through, talking about the lender contacts as well as proof of funds, and explaining how we will make the transaction easier for the seller. Now, but making it easier in the sense that these are all tenant-occupied properties, and it can be a huge hassle and a disruption if multiple buyers are going in and out, or a single buyer going in and out multiple times. Once you have that established with the seller, negotiate the initial asking price, negotiate other costs, the terms of the deal, and of course, after you're in contract and do the inspection, negotiate the anything for the repairs, additional repairs that may show up on the inspection. So just a high-level view of operations after the acquisition, and then I'll get into some more numbers. The gross monthly rents will increase from $14,000 to $20,000 within the first 6 months of the ownership. Key part to that, we start scheduling work orders for repairs as well as deferred maintenance immediately after the acquisition, and which allowed us to start to increase the rent within 2 weeks of acquisition. You can see here a list of some of the high-level repairs we did in those 6 months. A lot of piers, roofs, garage conversions, HVACs, and flooring that we had to do. So let's talk a little bit about the numbers in phase 1 for this project. The purchase price is approximately $1.4 million or $70,000 per door. We're building a rehab budget of $200,000 in the initial loan, which the total loan came up to $1.3 million, and the total capital required to raise and close this was $650,000, which is what we raised to close on this. The $650,000 included the down payment, closing costs, syndication costs, the maintenance reserves, as well as an operational expenses. So just like any other single-family acquisition, you would have your down payment and closing costs. The little bit unique here is you have to keep a reserve of funds in case anything goes wrong or you find something majorly wrong with the houses and the syndication costs. After some of these repairs and the increases in the rents, the current market price for these houses are estimated at $2.4 million or $120,000 per door. Phase 2 of this project that we are looking at currently is to refi the current loan, which is on the left side of the slide. Refi estimated at 65% of $2.4 million at $1.5 million. The key there is it's a non-recourse loan with so the borrower doesn't have to provide a guarantee. The remaining equity left in the current syndication still of $900,000, and after paying the current loan, there's a net proceeds of about $250,000 from this refi. And so, what do we do with those $250,000? On the right side, you see we can add additional income to the syndication without any more money from outside money into the syndication. So we have another deal of 8 duplexes with 16 doors with a purchase price of $800,000, loan amount of 65% at $520,000, which would require a cash of about $280,000. Which can be funded from the refi of the existing syndication, and we can add a monthly gross rent of another $10,000 to the existing $20,000. So combining these two, where it leaves us with the phase 2 is total stabilized value of the portfolio is around $3.2 million, with a total loan of approximately little over $2 million. Equity left in the combined syndication, $1.1 million, and a gross monthly rental revenue to more than $30,000 a month, which really bumps up the original cash flow from 8 to 10% to a 12 to 15%. And of course, we're funding this through the syndication cost. So very interesting project for us to kind of do it in 2 phases and add a huge cash flow at the back end without any additional money. Phil, you have any other comments or anything else to add to this?
Well, that was a really cool project, and let me just try to summarize kind of what I understood from what you just said. So through networking, which is part of marketing that you're always doing, this deal came to you. You evaluated this deal and you saw an immediate opportunity. As I see it, I think there were 2 opportunities. One, you could buy these things at about 70 cents on the dollar, which is by itself a great deal. And number two, these things were rented dramatically under market rents. When you looked at what they should be renting for versus what they were renting for, there was a huge upside potential. So you could have just bought and done fix and flips, but instead you bought this whole thing as a portfolio. You financed it through syndicating money and buying this whole thing as a portfolio. And then what did you do? You treated it like a multifamily project, and you increased the rents, therefore increasing the value of the portfolio. At which point it came time to just refinance your approved property back out. Get a new loan at the higher, based on the higher valuation of the property. You could have stopped there technically, right? But because that refi, because the value of the property portfolio had gone up so much, and there's actually cash coming back from the refinance. So you got a little creative here, and you decided, well, we could, I guess, reimburse or just pay that cash back to the investors, or we could use that cash to buy another 16 doors. So I guess that was a consideration at that point. You could have just paid that money back to the investors, correct?
That's correct, yes.
But you found another deal, and you said, well, we can really sweeten the pot here by using the phase one cash back to finance phase two. So adding another 16 doors dramatically increases the cash flow of the portfolio and the value of the portfolio. So now your investors are getting, you said, 12 to 15% return on their money. Is that correct?
That's correct, yes.
And that is a lot better than a poke in the eye with a stick. So any other lessons, Sanjay, that you learned from this whole project?
I think the biggest lesson, two biggest lessons I would say is the first one is that network. I would not have come across this deal without the network. And then the second thing is, lenders and financing. There's a lot of things you can do, creative things there, but you have to have that relationship with the lenders and keep working on that.
Yeah, and those were some key points you made about, looking strong to the seller and looking strong. I think a lot of people, when they negotiate, they underestimate the importance of this. There's a lot of investors out there that don't really have money, that are just wholesalers, that are just jerking people's chains, and the sellers figure this out sooner rather than later. So one differentiator you did here is you showed them proof of funds. You kind of statured up and showed them that you're part of a group that really has money and resources and experience to take down this deal. And that's worth a lot to a seller. Because there's nothing worse than somebody saying they're going to buy your property, and then especially something like this where they have to do all kinds of inspections and due diligence, and it turns out they really didn't have the money or resources to pull the thing down. So thank you so much, Sanjay, for reviewing this very successful project with us all. Each week we review deals with the Canis Major Deal of the Week video blog. This is our deal of this week, and we'll have another one next week. Thank you all so much, everybody, and we'll see you on the next call.